All right, well, good morning. It is 11 o'clock, and thank you for joining me today for our annual applicable large employer reporting. This is going to be for calendar year 2024. I am Senior Vice President of Town Benefits, Corbin Granger, and thanks for joining me today. A couple of housekeeping items. I will send out the presentation. There will also be a recording housed on our website. And of course, if you have any questions, I'll be happy to answer them at the end. Now, as a disclaimer, this is always based on what current information we have, so future years could change. This webinar also doesn't cover certain additional ACA state reporting requirements. So there are some additional requirements for employees in states like California, New Jersey, Rhode Island, and Washington, D.C., because those states also have their individual mandate. So we're going to be talking on the federal level today. So the 2020 forms and instructions, the law first came out and said you had to provide the statements to the individuals January 31st. And thankfully, I know we all have enough going on during the holiday season that this has really been permanently changed to the beginning of March. And this year it's March 3rd, 2025, to distribute the 1095Cs to your employees. You file them with the IRS using the 1094C, which is the transmittal form, and copies of the 1095Cs to the IRS by March 31st, 2025. If you notice, it says you have to file electronically, and that is true. Last year was the first year the IRS required electronic filing. They made an exception if you as an employer file fewer than 10 tax returns in total, which basically means everyone has to file electronically. So the affordability percentages that we're looking at about for 2024 is 8.39%. And when you're completing your 1095C forms for individuals who waive the coverage, there isn't a form, there isn't a code for waiving coverage. There's a code to show that the offer was affordable. So you can choose 8.39% of their Box 1 W-2 income, which generally must be used for all months the employee is offered coverage. You can't mix that one up with one of the other safe harbors. 8.39% of the employee's rate of pay, and that's times 130 hours per month, or 8.39 of the federal poverty level for the year, which would be 101.94 for 2024. Why do we complete these forms? What is this all about? And really, it's about what we like to call the pay or play penalties. So the first one, the A penalty, we refer to as the nuclear penalty. And the reason is you have to show that you've offered at least minimum essential coverage, and that's really unlimited preventive coverage, to 95% of employees and dependents. If you fail in meeting that percentage, so let's say you miss 10 or 15 employees that they didn't receive an offer. Well, if one full-time employee goes to the marketplace and gets a subsidy, then you as the employer are going to be taxed or you're going to receive the penalty, which is annualized at $2,970 times number of full-time employees minus the first 30, or it's $247.50 per month. And if you have other members within a control group, that minus 30 is shared. So you always want to be aware of the nuclear penalty. And as we go forward, I'll show you some mistakes that employers sometimes make. And then they get that letter from the IRS saying they didn't offer coverage, and then they have to contest it. The second penalty is the B penalty. And we really call that the unaffordable penalty, because that one is triggered if a full-time employee receives a marketplace subsidy because your offer was either not affordable, as I defined before, or not minimum value. So I get this question a lot. If somebody accepts my offer as an employer and the offer wasn't affordable, and am I going to be penalized? And the answer is no. You will be penalized if an employee goes to the marketplace and receives a subsidy and it turns out your offer was not affordable. And this penalty is higher. It's $4,460 per full-time employee that receives a subsidy, or $371.67 a month. And again, each entity, if you're within a controlled group, will be tested on these separately. So let's look at the purpose of the 1094 and 1095C forms. The 1094C is really your transmittal form or your cover sheet to transmit the 1095Cs to the IRS. It tells the IRS, this is coming from my company, and these are the forms that we are submitting. The reason you have this cover sheet is it's for the calculation of the nuclear or A penalty, because it reports if minimum essential coverage was offered to 95% of full-time employees and dependents for every month of the calendar year. So let's look at the 1094C. It has a couple of parts. It looks very similar to a W-2, I imagine. Part 1, you're going to complete lines 1 through 16. It may be a little hard to see here. On line 18, you're going to indicate the number of 1095Cs that you're submitting. And on line 19, each entity must have an authoritative transmittal. So if you have a company with more than one division, but it's still the same company, you're going to have one that has it as an authoritative transmittal. And usually it's just easier to have that one entity submit for every division. Okay, so on part 2, again, you complete the number of 1095 forms, of forms 1095C. You indicate if the member was part of an aggregated ALE group or a control group. And line 22 simply represents optional ways to file the 1094C. You do not have to use either A or D. If neither applies, you can leave it blank. And then again, there's a place for the responsible individual to sign, but because you're e-filing it, that will happen a little differently. So what is line 22, the qualifying offer method? The qualifying offer method just means that an employer is using the federal poverty level safe harbor. So that employer is charging employees $101.94 a month, maximum or less, and offers coverage to both spouses and dependents. And what that means is there are some other ways of providing these statements, and it simplifies some of the reporting, but I don't believe that most employers will be able to use that qualifying offer method because it is tied to the federal poverty level. It does not mean that your method, that it qualifies under ACA. It means that you're offering a safe harbor under the federal poverty level. The one that a lot of clients can probably use is the 98% offer method. And what this means is if you are offering affordable minimum value coverage to at least 98% of the employees each month for whom you're filing a 1095C, then that applies. So if you're an employer who's offering affordable minimum value coverage to 100% of your employees, then this would qualify. You have to have at least offered MEC to the employee's dependents. And why is this method popular? This method is popular because, as you're going to see, you're not required to complete column B on the 1094C, meaning you don't have to list full-time employees each month. You still must list total employees, but the IRS says that is our gift to you. You are using this 98% offer method, so we're not going to make you list out how many full-time employees you have. So here, the 1094C Part 3. Now remember at the beginning, I was referring to the A penalty, the nuclear penalty, that if you fail to offer coverage to 95% of full-time employees and dependents, you check no. I cannot tell you if you are on the line, unless you're a brand new employer and you started in the middle of the year, like in June of this year, everyone should be able to report that they offered at least minimum essential coverage all 12 months of the year. I have seen over the years many times employers unknowingly check the no box, or they don't know to tell the payroll company, wait, hold on, we are offering coverage, we are offering it to 100% of our employees. That should be a yes. So keep that in mind. If you end up checking no, when you really are offering either MEC or minimum value coverage to 95% of your full-time employees and dependents, then you're going to get an IRS letter in about 2 years. The column B, you do not need to complete if you're using the 98% offer method. Okay. So that's the benefit of the 98% offer method. In column C, you do have to include a total employee count. And what the IRS is looking for there is they're saying, if you have like 8 full-time employees, but you have 300 total employees, that's sort of a trigger to them that like, what's going on here? You know, so you report the total number of employees, and of course there's a system. You can do the first day of the month, the last day of the month, the 12th day of the month, or my personal favorite, the first day of the first payroll period in the month, or the last day of the first payroll period, if that falls in the calendar month when the payroll period starts. In my humble opinion, it might just be easier to use the first or last day of the month. Column D is only if you are part of a controlled group. They call it an aggregated group indicator. And column C is reserved and has been for a couple of years. Part 4 only applies if you have other entities that are members of your controlled group, and you will list them there. And then as the other entities file their 1094 and 1095-C forms, they will list your entity. But that only applies if you're a member of a controlled group, or what we call an aggregated ALE group. After everything is completed, again, you're going to include the 1095-C forms and transmit them electronically. Okay. So let's move on to the 1095-C. The 1095-C is used to report offers of coverage to every employee that qualified as full-time for 1 or more months in the calendar year. Okay, so you may have an employee that started January 2024, left June 2024. Even though they're not there the whole year, you're going to complete a 1095-C for them for the entire year using the codes. And if they're self-insured, if you as a company are self-insured, then you're going to show enrollment in coverage of employees and non-employees. So what do I mean? I mean that plans that are fully insured for the entire calendar year complete Part 1 and Part 2. If you have a plan that's self-insured for any month in the calendar year, you must also complete Part 3 for those months. And that's going to include individuals coverage. So it's going to include the employee, spouse, and dependents that are enrolled in any month of the year. And the reason for that is it's reflecting the individual mandate penalty, the mandate to have insurance. Even though the penalty has been reduced to 0, the IRS has not taken away the responsibility for a self-insured group to report this. If you are fully insured for the entire calendar year, you will get a 1095-B from the carrier. So let's look at the 1095-C. And I try to structure this as I go through it to show how the codes work together. So Part 1, similar to a W-2, you have the employee's name and information. You have you as the ALE member. And then Part 2 is what I like to call the crux of the form. So you're going to see it on the next slide, but you only put the employee's age in on January 1 if you're offering an ICRA, individual coverage health reimbursement. You do put the plan start month in. But let's look at for a second. Line 14 is the offer of coverage code. So you're either going to use 1H, which means there is no offer, or you're going to use a code that shows you made an offer. Line 15 is the employee's required contribution, and that's going to just be the lowest plan self-only amount. It's not necessarily going to be what they took. And then line 16 always explains line 14. And that's what we call your safe harbor. So that's where you put in, did the employee enroll? But if they didn't enroll, was it affordable? And they're codes that reflect those 3 affordability safe harbors. Line 17, the zip code, only applies if you're offering an ICHRA, individual coverage health reimbursement arrangement. So as I said earlier, you only put the employee's age if they're in an ICHRA. The plan start month, it's going to be from 01 to 12 for the month when the plan year begins for everyone. So if I come to you in the middle of the year, but your plan year starts January 1, it's going to be 01. It's not when I'm eligible, it's when the plan year starts. If you ended up having a short plan year, you had 2 plan years that came together, just use the earliest month. I can't imagine that there would be anybody on the line that isn't offering a health plan at all. But if you weren't, use 00. And again, line 17 is the zip code, and that is if you have an ICHRA, because the testing of affordability for the ICHRA involves the individual's age, where they live, or where they work. They've created all new codes for that. So line 14 is the first column in part 2. Never, ever, ever leave line 14 blank. There always should be something you can put there. Either you enter the code that applies for the month. If someone's worked for you all 12 months and they've been offered insurance all 12 months, you can use the all 12 months box. If you're offering someone health coverage, it needs to be valid for the entire month. If you use 1F, so if you are only offering minimum essential coverage, you cannot use a safe harbor on line 16. And the reason is because if someone does not take your MEC plan, then they are eligible to receive a subsidy on the marketplace. And so MEC plans are not dictated by affordability. So you have here 1A, qualifying offer. Now remember, that refers to the federal poverty level. It does not mean that the offer qualifies under ACA. 1B, that really applies under a COBRA situation. You could have 1C, employee plus dependents, if you're excluding spouses. 1D, you shouldn't just have that. Really what we normally see is 1E, family, employee, spouse, and dependents. 1F, again, is a MEC offer. And then 1G is for an individual, maybe somebody who terminated earlier in the year, and they're enrolled in a self-insured plan, but they're not full-time. 1H is no offer. And there are many reasons why you would use 1H. Perhaps the employee wasn't employed that month. Perhaps the employee was in a waiting period. Perhaps that employee changed to part-time, or it's in the month that they terminated. 1I is reserved. 1J would be if you're offering the employee and you're only conditionally making an offer to a spouse. I was on a call earlier today where this company, they only offer spousal coverage if the spouse does not have access to coverage at their place of work. So that will be a 1J. And 1K, excuse me, that would actually be a 1K, employees and dependents with conditional offer to spouse. All right. So let's look at 1H, the no offer code. 1H should always be paired with the appropriate line 16 2 series code. Because remember, line 16 explains line 14. So 2D means you didn't offer me coverage because I was in a limited non-assessment period. Maybe I was being measured for 12 months, or what we call a waiting period, or the first month of employment if there's no offer of coverage. 2B will mean I was part-time, but generally you will use it for the month of termination. If the employee terminated before the end of the month and they weren't enrolled until the end of the month, or if the offer stopped before the end of the month. So for example, I terminate in the middle of June. My offer would have continued had I stayed till June 30th, but I didn't. So 1H, 2B is to let the IRS know Corbin is gone. She wasn't there the entire month, and so there's no assessment for her. 2A is if the employee was not employed any day in the month. So that would come into play for employees that terminate during the year or employees that come on later in the year. Because once they start working, it's going to be a different 2 series code. Now let's say you're offering coverage. You always want to reflect the highest tier of coverage that you're offering to the employee. So when you use an offer code, it's not what the employee took or didn't take. It's the highest level of coverage that you offer to them. So 1A, again, is an offer to the entire family using the FPL. So 101.94 for 2024, or if you cover 100% of the employee-only cost, and you make an offer to the family, but you don't subsidize that sort of thing. 1E is the one we'll see a lot, which is family coverage. And so with these codes comes a line 216 code, a line 16 code. 2C, the employee enrolled in coverage. 2F, the employee did not enroll, but it was affordable based upon their Box 1 W-2. 2G, the employee did not enroll, but was affordable based upon the federal poverty level. And 2H, the employee did not enroll, but it was affordable based upon their rate of pay. So sometimes I get the question, well, why isn't there a waiver code? And the reason is you as an employer are only required to make an offer. It's up to them to accept it. So they don't want to know if someone waived coverage. They want to know what your offer was and whether or not it was affordable. So here are the ICHRA coverage codes, and I'm not going to go through them because they're talking about it's offered to the employee and the affordability is determined by their zip code, by different zip codes, where you live, where you work, et cetera, et cetera. And there's actually 2 screens of this. So again, line 14, you're looking at the highest tier offered. And let's say we're going to use the all 12 months box here. So employee is offered a plan for all of calendar year 2024 that would cover his or her entire family should they choose to take it. And so in line 14, that would be a 1E. If the person came in the middle of the year, then you would have to complete each box. So let's show you again. Line 14, the offer is not for all 12 months. So here we have a situation where Tom is not an employee. He was hired by Levon Helm Company in February, and he's eligible for an offer of coverage on the first day of the month following his date of hire, which is March. And the offer of coverage is to Tom's entire family, which is a 1E. So if you notice, I've completed here line 14. January is a 1H, February is a 1H because he was not an employee in January, and in February he was in a waiting period. Starting in March through the end of the year, he had an offer of coverage 1E. I like to say these tell a story of each person's experience with the company. Line 15, again, you're going to indicate the lowest self-only cost. So they offer Tom an HMO for $200 a month, self-only, and a PPO for $275 a month. So it's going to be the HMO is going to be the self-only cost reported on line 15, as that is the lowest cost minimum value plan. Now there is a caveat to that. Let's say you have employees in Colorado and you're here in Virginia and the HMO does not apply in Colorado, then the PPO would be the lowest self-only costing plan for Colorado employees. Because remember, it has to give them minimum value. So if the employee's contribution was the same for all 12 months, you can use the all 12 months box. You enter the amount, including cents. If you have, if the employee contribution is 0, you can put 0.00, and you don't leave it blank. The only exception to this is if you use the 1A code, you leave line 15 blank. If the plan is a non-calendar year plan, so let's say January through June, it's 200, and then July through December 31st, it's $210. You have to reflect that on the 1095-C. In this case, it's $200 from the time he is eligible to the end of the year. Line 16 codes. Line 16, I like to say, is your friend. Why is it your friend? Because it explains line 14. And this is where the IRS goes to look for applicable penalties. So these are safe harbor codes that are designed to explain to the IRS what's happening so that they can't assess a B penalty. The exception to this is if you're only reporting MET coverage, you do have to leave line 16 blank. Please complete line 16 unless there is no safe harbor code that applies. So again, here are the line 16 codes. 2A, employee not employed on any day of the month. 2B, the employee not full-time, but mostly it's used in the month of termination because employees rarely terminate the last day of the month. 2C, it means they're enrolled. 2D, they're in a limited non-assessment period or waiting period. 2E really applies to union plans. 2F, the employee was offered but waived, but it was affordable based on their W-2. 2G, it was affordable based on the federal poverty level. 2H, it was affordable based upon their rate of pay. So here, Tom, as we know, is eligible for coverage in March as a full-time employee. Okay, so now we're going to put all the codes together. 1H and 2A, because he wasn't employed at all in January. 1H and 2B, because he did come to work in February, but he was in a waiting period. 1E, because the waiting period ends and he's eligible for coverage the first of the month following the hire date. He's 1E, 200 for the cost. Now, in this illustration, you can see the code is 2C, so he enrolled in that coverage. 1095-C, COBRA and break-in service rules. So for employees that have terminated, COBRA offer is reported as 1H, no offer of coverage. But if the plan is self-insured, you still report it under Part 3. And the reason for that is once the employee terminates, they're no longer accessible to you. They can't call, you can't be penalized for them. Now, if COBRA is offered due to a reduction in hours and that employee is in a stability period, still full-time under ACA, it could generate the B penalty if the cost of COBRA is not affordable. So for those clients who use the look-back method, if Tom is in a stability period as full-time, but he reduces his hours, he's still full-time under ACA, and so you probably would not want to offer Tom COBRA until the end of the stability period. If you offer Tom COBRA in the middle of the stability period, he still has to be reported as full-time. And if Tom doesn't take the COBRA and goes to the marketplace and gets a subsidy, then that could generate a penalty. Break-in service rules, rehired employees can be treated as a new employee for ACA, and you can apply a new waiting period if there's at least a 13 consecutive week break in service or 26 weeks for educational institutions. And seasonal employees should usually have a greater than 13-week break in service. The rule of parity applies if it's applied uniformly, so that would be a break in service of at least 4 weeks where no hours are credited and the break in service exceeds the employee's prior employment period. So if someone works for 3 weeks and the break-in service is 4 weeks, then that could work. But most companies, it's the 13-week consecutive break. So let's look at the self-insured part of the 1095-C. So the third page is Part 3. Again, it only applies to employers with self-insured plans. They must list all covered individuals. And this includes individual coverage HRAs. Employers with fully insured plans for the entire calendar year can leave Part 3 blank. So Part 3, covered individuals, self-insured. You're going to report all individuals covered if you're self-insured, including COBRA. Employees and family members covered are included for the months enrolled in coverage on the same 1095-C. So you list the first name, middle initial, last name, Social Security or taxpayer identification number. You only enter a date of birth if the taxpayer identification number is blank. If the individual was not covered for all 12 months, then you list each month. You put a little checkbox in every month that the individual was covered. So, for example, Tom Smith and his wife were covered for all 12 months. And then they had a baby, and he was born in September. And so you can see the checkbox September, October, November, December. It's important to remember that the good faith effort relief has been eliminated. So there are penalties for filing failures. Employers can be penalized for late failures, failure to include all the required information, and incorrect information. Separate penalties do apply for forms filed with the IRS and for statements furnished to individuals, so you can get double penalties. The 2024 form penalties are $330 each for each return due to be furnished and filed in 2025. And if the failure is corrected within 30 days, it can go down to $60 a return, or corrected after 30 days, but before August, it can go to $130 per return. Now, we're all going to get everything reported correctly and on time to the IRS, but that is, I just like to let people know of the penalties. And so with that, I have actually ended this section of the presentation. So if anybody has any questions, I'll be happy to take them now. And remember, I will send you out this information and a link to the recording. All right, well, I don't see any questions. I'd like to say thank you all for attending today. I hope you have a wonderful holiday season, and thank you for being a client of Town Benefits. You have a great day.